Hello, everyone, and welcome to today's NOVA presentation, Common 401k Plan Errors, hosted by Steve Vest. Before we get started, I'd like to go over some housekeeping items. First, I'd like to point out the question mark icon at the top of the webinar screen. This is where you'll enter any questions throughout the webinar you have for Steve. I'll go ahead and read them once they're asked. If time runs out and your question was not answered, please email us at webinars@nova401k.com and we'll make sure your question gets answered. Right next to the questions, you'll see a paper icon. This is your handouts dropdown, where you can find today's material in PDF form. If you are unable to view or click on the handout, go ahead and send us an email so we can provide you with that PDF. If you are with us today to earn continued education credits, please be sure to stay until the end and fill out the pop-up survey. This will help us track your time and participation. Certificates will be sent out within a week for those who have met the time requirement and fill out the survey. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is nova401k.com/webinars. Thank you so much for joining us. I would like to now introduce today's presenter, Team Leader of Special Projects and Shareholder of Nova, Steve Vest.
Good afternoon, everyone, and welcome to the webinar. Again, this webinar is going to be about some of the more common 401k plan errors that we see in our practice, as well as errors that the IRS has also identified as very common to their plan audits. Quick disclaimer that, again, this is just a presentation of general information and not intended to be taken as legal or tax advice. And if you need that kind of advice, please consult a qualified attorney and or accountant. A little overview of some of the subject matter today. We really want you to be able to identify who and who is not a fiduciary to the plan. A lot of you on the call right now are probably fiduciaries and you don't even realize it. So we'll go through, what constitutes a fiduciary. Also, we want you to be able to identify what are some of these common administrative errors so you can avoid them and also know how to correct them if they do occur, which does happen from time to time. Quick little overview of the service model that Nova uses. We use what's really called an unbundled model, where there are several different keys to the puzzle on who's doing what in your 401k plan. So for any 401k plan, there are 4 distinct roles that have to be played by somebody. You are the plan sponsors to the plan, and as plan sponsors, you have overall fiduciary responsibility, but primarily your job responsibilities include getting the deductions that individuals make on how much money to take out of their pay into your payroll system so that the deductions can be taken, and then remitting those contributions to the investment company in a timely manner. Some of the slides later in the show will talk about what that means to be timely in terms of those remittances. Each year, we as the TPA are going to be asking you for census data. So part of your responsibilities include collecting that on an annual basis and giving it to us so we can handle some of the testing. And that's where Nova comes into play. We are the compliance specialists to the plan. We complete all of the non-discrimination testing, and there are 4 or 5 different non-discrimination tests that have to be passed annually. We help prepare your Form 5500 so it's signature ready for you to submit to the Department of Labor. We provide ongoing consulting and then also keep your document up to date with all the latest IRS and Department of Labor legislation. You've also, each of you may be using different investment providers. We partner with as many as 10 to 15 investment providers, and they are where you send the money. They provide the internet access, all the mutual funds that the money that you're taking out of people's paychecks actually go into. And they do the record keeping to keep all of the money, buckets of money separated out, the deferrals and the match and so forth. And then finally, because neither the investment provider or us as the TPA can provide specific investment advice. We're not licensed for that. You have financial advisors who also are attached to your plan that can help your participants if they need help selecting investments or what the best mix of allocations of mutual funds might be for them. Those individuals also can help with enrollment meetings and providing education to your participants about how to invest. So together, we feel like this is the best model that can be used because we're all specialists in our individual fields and can provide very specific service to your plan. So why is all of this important? What we find is that operational failures, which are failures to operate your plan in compliance with the provisions that are in your plan document, are much more common than penalties and costs and fees that happen because of the investments that are actually in the plan, like having inappropriate investments. You usually hear on the news a lot about investment related losses to plans, and that might be an issue at the mega plan level where you've literally got billions of dollars in the 401k plans. But at the smaller level and mid-sized level that we're at, we find that operational failures are much more common and costly to the 401k plan. Also, it's important to understand that fiduciaries do bear personal liability for fiduciary breaches. Not all the errors that we're going to be talking about today are qualify as a fiduciary breach. That's a much more serious kind of matter. But there could be losses that might cost the company money in terms of having to contribute additional employer contributions to the plan. So we want to try and avoid that. The Department of Labor and the IRS are very active in monitoring these plans and also, assessing penalties and plan restorations, which are contributions that might have to restore balances to participant accounts. These are some of the IRS penalties. They used to be much smaller, but they've literally gone up by 100x over the last several years. And so we commonly see penalty notices from the IRS on, let's say, late 5500 filings that are $30,000, $40,000 per filing that's late. Just to give you some idea, the Department of Labor is even worse. I've seen some penalties for incomplete filings of $150,000 per form. So I mean, it can be pretty onerous depending on the error and the penalty. So everything is correctable. I always like to tell people no one's going to 401k jail if you make a mistake, because most errors can be fixed under the Employee Plan Compliance Resolution System, which is an IRS correction program, and it consists of three parts. Some errors, depending on how the severity of the error, can be self-corrected, meaning you don't have to submit anything formal to the IRS. You just fix the problem using their principles in this program on your own, of course, with our help, right? And you don't have to submit anything formal. Certain errors are not correctable or self-correctable, and there has to be a formal filing under the Voluntary Correction Program, the VCP program. Certain document failures, if you've never adopted you've never had a signed document that you can find on your 401k plan, there are certain errors or very custom fixes that fall outside of the boilerplate template fixes that are in the self-correction program. If we want to try something different, we have to ask the IRS for approval on that, and you do that through the VCP program. Now, if you get caught, when you haven't formally filed under the VCP program, you then fall under audit cap, like you've just randomly been audited and they find errors. Now the penalties that they might assess are under the audit cap program and a lot more significant. In order to actually formally file under the VCP program, there is a filing fee, and it's just based on the size of the plan assets at the end of a particular year. And so smaller plans, it's $1,500. If you're most plans fall probably between, again, in the mid-size to small plan market, fall between 500,000 and 10 million. So it's a $3,000 fee. And then if you're a little bit larger plan, 3,500. So who is a fiduciary? There are three types, and we're not really going to deal with the first two. We really want to focus on what we call the 316 plan administrator fiduciary. The other two are investment-related fiduciaries. Your investment advisor that we talked about before, and the investment company or the investment managers that manage the assets in the plan, the mutual funds, if you will. Those are investment-related fiduciaries. Now, anybody can be a fiduciary if they exercise any discretionary control over the plan administration or over the plan assets, or they render investment advice to the plan for a fee. Okay? So any one of these things can catch you and make you a fiduciary. So some examples are, your investment advisors, the trustees to the plan, these are named individuals who are in your legal plan documents. The investment managers, that manage the mutual funds that are within your 401k plan. But if your company has an administrative 401k committee, all the members of that committee are going to be fiduciaries because they're making discretionary decisions about the plan. Should we amend the plan? What they have the power to control the plan. Plan administrators as well that are dealing with the day-to-day operations, and any owners or people at the company who are involved in hiring any of the above, right, are going to be caught as fiduciaries. So that can be, multiple levels of people in your company, but definitely the owners typically. So the 316 fiduciary is an individual who is considered the plan administrator. The person might be named in the document, but normally isn't. Right? We don't put specific names to the plan administrators because there's always turnover in your companies. So the trustee of the plan, who is typically one of the owners or higher level individuals in a company, might delegate responsibility for administering the day-to-day operations of the plan to someone in HR, or it could be anybody in the company, but whoever that person is responsible for managing the daily operations of the plan, and that makes them a fiduciary. That's important to know. That might be you on this call. So what about NOVA? Well, again, NOVA takes the position that we are only handling a ministerial administration of the plan. So we prepare the testing for your review. We prepare a 5500 for your signature, but we're not signing it, right? We keep your plan document in compliance, but we don't sign the plan document. You sign the plan document. So we're sort of like the CPAs behind the scenes helping you administer the plan, but we're not really signing anything. At the end of the day, you have to review what we provide to you and then execute the documents that we're giving you. So we're not a fiduciary. So again, basically what I just said in the previous slide, we're just preparing, but we're not at, loans and distributions. We may review those, but someone typically at the company level gets the final sign-off authorization, the approval step, when somebody takes a loan or a distribution. So it's important to understand, if you're that person, you're a fiduciary. So some of the responsibilities of, again, the plan administrator, and it's going to be somebody at the employer, is to distribute the annual notices. We help prepare many of these notices, and so do the investment providers, like the fee disclosure 405 notices. The summary plan description is the layman's explanation of the provisions of the plan that you're supposed to hand out to participants, approving loans and distributions. I won't go through all of these, but these are some of the more typical responsibilities of the employer. And again, the employer is the 316 plan administrator. technically. So one of the more important ones, enrolling your newly eligible employees, your new employees who become eligible for the plan on time, sending in the contributions from the payroll system to the investment provider. All right, signing and filing the 5500. These are very important duties of the plan administrator. So let's get into some of the errors. One of the more common ones is the failure to amend the plan for, for new law changes. Okay, so employers are required to amend their plans and keep them up to date. Congress is changing the legislation all the time. We've had several new laws passed since COVID. We had the Secure 1.0 and Secure 2.0 acts that were passed recently that made a lot of changes to the 401k plan industry. So also in addition to, new legislative acts, the IRS requires that the plan documents that we use, which are typically template documents with check boxes, right? They approve these template documents, which are empty at the time, about every 5 to 6 years, and require a complete update to the latest document. And so it's important that these be done on time. The most recent major restatement was what we call the tri-cycle restatement, and that was actually due no later than July 31st of 22. If you miss a deadline for updating on time, then we need to have a VCB submission to fix that problem in most cases. Again, not a problem, but it costs money to retroactively amend a plan document to get back into compliance. So another very common problem is the failure to sign up all of your affiliated employers. So in these legal plan documents, only companies that have executed the plan, which are typically going to be the main plan sponsor, or any other companies that you have that might be affiliated or controlled by your one company, have to execute participation agreements. So think of them as sign-up agreements. If they're not signed up, even though they're part of your affiliated group of employers, they're technically not eligible to participate in the plan without that adoption agreement, that sign-up agreement. Now, what companies generally would be signed up for the plan? So all companies within what we call a control group should generally be participating in one plan. Okay, there are exceptions to that. Can I have one company and have two separate plans? Perhaps, but it involves some more complicated testing that NOVA would have to help you with. Now, what is a control group? There are basically two types. We have parent subsidiary control groups, which is when one company owns at least 80% or more of another company. You've got a parent company and a subsidiary with at least 80% ownership by that parent. You can also have companies that are owned by individuals. So if the same 5 or fewer individuals commonly own 80% or more of two companies, then again, the IRS views any companies in either one of these types of groups as basically a single company when it comes to participating in a plan, right? So how do we avoid this problem of not having all our employers signed up or not amending the plan on time? Again, NOVA is here to help you with this plan document issue. We monitor all of the latest legislation. We know what the deadlines are for amending, for required updates, and we send out a lot of correspondence to that effect. So please, always read our emails, especially when it comes to your documents on required amendments, and make sure that if we're talking right now about affiliated employers, if you're not sure, like you've got some employers that fall into that category of being at least 80% owned by parent, or you've got the same couple of people that own 3 or 4 companies, and you're not sure if all the companies are signed up, give us a call because we need to know about that and see if you've got a problem. But just be thinking about whether all of your companies are signed up for your 401k plan. Anytime you have an acquisition or you're about to sell one of your employers, or maybe you're selling your entire company to somebody else, please contact us as soon as possible. We have expertise in mergers and acquisitions and spinoffs, but it's very difficult to your options on what to do with your 401k plan when we find out about an acquisition or a sale of a company after the fact shrink dramatically. It's much better for us to know about that ahead of time so we can consult with you appropriately. And just make sure as you read that correspondence that you do sign these documents and amendments by those deadlines that we're giving you. Another very common problem is the failure to follow the provisions that are in that written document in actual practice. So the IRS requires that you follow those terms that are written in the document in real life. And if you don't, they reserve the right to disqualify your plan completely if they audit you. So we want to be following in real life what the actual plan document provisions are written as. So, for example, the plan in the written document has a definition of compensation, and sometimes employers we find are using a completely different definition when it comes to payroll and running deductions from employees' paychecks. So that can result in participants getting incorrect allocations, having the wrong amounts taken out of their checks. If you're making an employer contribution and you're computing it on the wrong definition of compensation, again, people are going to get the wrong amounts put into their 401k plan. So just so you know, Nova doesn't try to make any super fancy compensation definitions in most of our plans. Most of our plans, the definition is total gross W-2 pay. All right. Can you exclude bonuses, commissions, overtime? Yes, but it does require some additional testing on our part, and there are limits to how much compensation, or if I'm trying to carve out certain items of compensation in my plan, and not give people employer contributions, for example, on those carve outs. I can do some things, but there are limits too, and it's subject to this testing. So again, if you don't know what your definition is, please talk to your account manager, and we want to line up that written plan document to what you're actually doing in practice. So a normal example of this would be if you had a matching formula, and the payroll system is just using a base pay that excludes overtime and bonuses, but your plan document doesn't say anything about that, and it's supposed to be total gross pay. You've got a problem, and it is a fixable problem, but what we're going to have to do is, again, Nova would have to make additional calculations on this excluded pay that you were not supposed to exclude, right? And give additional contributions to the employees. So not only is it going to cost the company more money in terms of additional contributions, but that's non-routine work for us, and then we have to charge extra to do these calculations because sometimes it can be quite extensive. Avoiding the problem is about reviewing your plan document. If you're not sure what your definition of compensation is, you need to first find out what that is. Your Nova account manager can help you with that. The part that we cannot help you so easily with is looking into your payroll system to see what it's doing. We get your census data annually every year. There is no way for us to really know on a payroll by payroll basis if you're actually using the correct definition of compensation in your payroll system. So, review what is your payroll system definition, and is that the same as what my document says it should be? Like if it's excluding bonuses, or maybe you did a separate bonus run in your payroll and your plan document doesn't say anything about excluding bonuses, you're supposed to apply participant elections and compute employer contributions on that bonus run, right? And we see a lot of errors in that respect, right? Especially when it's a separate payroll run. So just be on the lookout for that sort of thing. So one of your biggest responsibilities as an employer is to let your employees into your plan on time or per the provisions of the plan, right? And it doesn't matter what your HR policy says. It doesn't matter what your offer letter to an individual says. None of that matters. All it matters is what's in your written plan document. You're not able to do different things for different people. Like you have an executive that comes in and you want to waive the waiting period for that individual. That's a no-go. And it doesn't matter what you put in your offer letter. That has no impact on the plan at all. So, we find employers sometimes do mess this up where, you're not offering new employees the plan on time. Sometimes it's too early, sometimes it's too late. We see some of each. So again, for example, if you have no age or service requirement, no waiting period for your plan, and you don't offer Steve enrollment in the plan for 6 months, what do we do? Well, again, that excluded period that he was not offered the plan, we'd have to take the compensation and make up some of these missed contributions that he would have had an opportunity to make had you offered the plan on time. Right now, the percentage involved, there are different techniques on, what percentage you pick since he wasn't offered the plan on time. So there are ways to do that, but it will involve the employer making additional contributions to the plan. So just a little bit of background information that I like to stick in here because one of the more complicated things is, initial eligibility and how some of these waiting period computations work. But so everybody knows, the IRS maximum waiting period for a 401k plan is a 1-year wait and age 21 with a minimum of 2 entry dates. Okay, and we'll discuss how this works on the next slide. But now, a certain number of hours may or may not be required to accrue the 1 year of service, but typically in most of our plans, it's 1,000 hours. Also, the age requirement cannot exceed 21. There's no such thing as putting a 25-year-old age requirement into your 401k plan. And the last bullet, and we'll see how this works on the following slide, is difficult conceptually, but the initial computation period is for figuring out a 1-year wait is the 12-month anniversary date from the date of hire, the original date of hire, and then that date typically changes to the calendar year for all following years. So for those of you that have 1-year waits, this is how it's going to work. And this is what you should be doing when you're trying to calculate when somebody's eligible. Let's say somebody's hired 6/1 of 2022. You should go to the 12-month anniversary date, which is 6/1 of 2023 in this case, and ask the question, did this person work 1,000 hours in that period? Yes or no? And as you can see, it's crossing calendar years, right? So that first computation period is required to be, by law, the 12-month anniversary date from the original date of hire. So if the answer to that is yes, they accrue or they earn the 1 year of service credit on 6/1 of 2023. Now, this plan has semi-annual entry dates, 1/1 and 7/1. So even though they accrued 1 year of service on 6/1 of 23, you don't need to offer them the plan until 7/1 of 2023, which is the next available entry date, the next following entry date. Now, again, you're in June, you might as well offer them the plan in June, right? Or give them at least, 2 or 3 weeks to make up their mind on what they want to contribute and give you the opportunity to get the election into payroll. But, you don't need to take any deductions out of any paychecks that have a pay period prior to 7/1 of 23. Now, actually, to explain, let me go back one, too. Now, what if the answer is no? This person worked like 500 hours in that first period. Then to make it a little bit easier, our documents switch any following computation periods to the calendar year. So up here, um, if this was 500 hours, they don't accrue 1 year here. The next computation period you look at is going to be the calendar year. So you look at, did this person from, you know, 1/1/2023 to 12/31/2023 work 1,000 hours in that period? Yes or no? And if it's yes, then they get the 1 year service credit on 1/1 or 12/31/2023, right? Um, Now, if you think about it, right, if you had to track oddball periods like this for every single person in your company forever, it would make trying to determine how they, whether they become eligible for your plan quite difficult, especially if you got a lot of part-time people and so forth. So that's why the computation period changes to the calendar year. It's usually easier to measure. Now, shorter periods are just fine, and we see a lot of that in our plan. But when you're using a shorter period than 1 year, we call it the elapsed time method, and you're not looking at hours for shorter periods of less than 1 year. It's done on elapsed time method, and the way that works is, let's say I have a 3-month wait. You just start again from the original date of hire, and if the individual is employed on their 3 month, you go 3 months to their next anniversary date there. If they're employed on that 3-month anniversary date, it doesn't matter if they worked 1 day in that period at the beginning and 1 day at the end, they get the entire period, which is known as service spanning. So they just need to be employed on that 3-month anniversary date and they're in. Or if it's 6 months, same thing. Are they there on their 6-month anniversary date? Yes or no? If they are, they're in. You don't need to look at how many hours were worked. You don't need to look at how many days were worked. None of that. Okay. So this method is not going to keep your part-time employees out of your plan at all. All right. Because you're not looking at hours. You're not looking at status, whether they're part-time or not, and so forth. So again, quick example. If you have an employer, oh, actually, this is improperly excluding classes of employees. So before in the prior slide, um, if you were excluding, let's say, part-time employees, right? Can I exclude a class like field workers if I'm in, an oil company or something? Perhaps, but number one, it has to be in your plan document, right? And you also have to pass some additional coverage testing that we would have to do for you. There's a limit to how many people can be excluded as a classification. So the key part though is that it has to be in your plan document. You can't just, even if your health and welfare plan excludes part-time employees, that has nothing to do with your 401k plan. So we find a lot of HR people get confused and think that they can exclude part-time employees because they're not normally part of the health and welfare plan as well. And that's not how the 401k plan works at all. So similar example, again, part-time, seasonal are very common classifications that we run into that people are excluding in their payroll system when their document does not exclude them at all. I can tell you the IRS does not like service-based exclusion language in plan documents. Again, part-time, seasonal, temporary, they don't like these terms at all. And they view it as a way to circumvent the maximum 1 year waiting period that we talked about before, right? Because you can have part-timers that work more than 1,000 hours, and technically they would be eligible for the plan, but you sort of exclude them as a class. And so the IRS is really getting strict about this exclusion. In fact, so much so that the Secure Acts have new long-term part-time employee rules, and which is a whole nother webinar in and of itself. If you're interested in learning about long-term part-time employees, if you have any, please go to our YouTube channel, and we've got videos and webinars recorded on this. But basically, a long-term part-time at a high level employee is an individual who worked basically between 500 hours and 999 hours in a year for 2 consecutive years. So if you want to know if you might have a problem with these individuals, number one, identify, do you even have any? Like, again, it is what it sounds like. I've got part-time employees who I'm employing that same part-time employee year after year after year, right? And excluding them from my plan. If you've got that situation going on, call us. We need to look at it, because under these new rules, you now have to at least allow them, even if your plan document says they're excluded or you've got a 1-year wait or anything like that, you have to now let them in, at least for deferral purposes, for employee contribution purposes. The ability to exclude these people now is gone under the new rules. So just be aware, again, read your document, know what your eligibility provisions are. Do I have a 1-year wait, a 3 months, 6 months? What are my entry dates? So that you can apply the correct waiting period to your group. Generally, you don't want to be excluding any classes of employees anymore because of these long-term part-time employee rules. Is it possible? Yes, but we just need to be looking at it carefully if that's what you're going to be doing. All right. Also, good practice when you're I handle all of the audits for just random IRS audits for NOVA. And I can tell you, when the IRS audits a plan, one of the first things they want to see is prove to be Mr. Employer that you offered the plan on time to your employees. So to that end, I would say it would be a really good idea if you start a practice of collecting all enrollment forms from people, even if they elect zero, right? Alternatively, you can save if you're going to send people enrollment materials through email, for example, save the emails in a folder on your computer that shows who you sent it to and when and what was included. That could be proof, right? But I guarantee you the IRS that's one of the big things, like, show me that you offered the plan to your people on time and prove it. So what do I do about rehires, right? A lot of problems happen with rehires. So the key concept here is it's not as complicated as it sounds, but if you ever had a formally eligible employee who comes back, so if this eligible employee ever had a single vested dollar in the plan, even his employee money or her employee money, right? Then they never lose their prior service credits, right? So if they qualified under the plan, they had money in the plan in the past, let them in immediately. That's it, right? The only way you would kind of restart them on that initial eligibility, do I make them wait again to get in the plan? Is if they had 5 consecutive 1-year breaks of service. That's the only time, and that's going to be pretty rare, right? I've rehired somebody that never had any money in the plan, and they've been gone for 5 years, right? I mean, that should be a pretty rare situation. In general, your rehires, you want to offer them the plan. They don't have to wait again. The minute they come back, just offer them the plan immediately. So difference in concepts here on vesting versus initial eligibility. This can confuse people. By law, service for initial eligibility, as we said, has to be credited from the original date of hire. Okay. Service for vesting purposes, though, is computed on a plan year basis, and most plan years are calendar years, right? So you're asking the question, did the person work 1,000 hours in the calendar year? I give them 1 year of service credit for that, for vesting, right? And then the concept of vesting is, if it's how much of the employer money can I take home if I quit tomorrow, right? So if I'm 20% vested, I take home 20%. The other 80% goes into a holding account at your investment provider for reuse by the employer, which is your company. You can go even further. So even if somebody is eligible and has met the eligibility requirements for contributing, Some plans can put additional requirements on receiving the employer contributions. Now, this is not going to be for plans that are funding on a payroll by payroll basis. We would never write a rule like this into your plan document. But the plans that fund annually can have a rule like this where you're required to either be employed on the last day of the plan year or work a certain number of hours during that year in order to be eligible to receive the match or the profit sharing that the employer is giving. So that's a different service crediting idea. If you're normally, if you're payroll by payroll, as I said, this is not going to be a rule that's in your plan. It just doesn't work administratively. So loans are very popular in plans, and we see a lot of loan failure problems as well. But loans are, the ability of a participant to take money out of the plan, but not have it actually be a distribution, right? A taxable distribution. So money's going into these plans on a tax deferred basis. And, so you're not paying your taxes now. If employees need money, they can take it as a loan. They're borrowing their own money and repaying it back, but they have to meet some rules. So there are maximum dollar amount rules. We'll go through a few of these things. Also, they have to pay it back on an amortized basis. And one of the more common problems that we see is when employees take a loan and the loan repayment in payroll is not started on time. Like there's a big lag. And that's where we have to come in and kind of fix that issue. So if loan payments are not started on time, the loan becomes delinquent, right? Because if you've missed a month worth of loan repayments, the loan is never going to be paid off by the required maturity date under the IRS regulations. And if that happens, then it's going to be in default. So a delinquent loan generally has to be corrected or cured no later than the quarter following the quarter in which the first payment is missed. So if I become delinquent in the first quarter of this year, I have until June 30th, the second quarter, right, to get that loan current or cure it, if that's the term the IRS uses. If that doesn't happen, then at the 6-month point, the loan is required to be defaulted, which means it's going to be taxable income to the participant, and your investment provider will shoot out a 1099-R at the end of the year showing it's taxable, right? Because it's no longer a loan, it's considered a distribution. So some of your investment providers have to be told to default the loan after the 6 months, for example. Others will do so automatically. It just depends on who your investment provider is. Again, we've got a variety, Principal, John Hancock, Empower. We've got a lot of partners that we work with, and they all work a little bit differently. So how do I fix or cure a loan that goes delinquent? There's a few ways. You can either catch up some of the missed loan repayments in payroll, like if they've only missed a few payments, that's probably the easiest way to do it and get it current. The individual could just send in a lump sum payoff of the loan. That's usually not too popular because they don't have the money, right? So the other method is we refinance or we re-amortize the loan. So if I had a 1-year loan and I miss a month, I refinance it over 11 months, which kind of increases the payment a little bit, but doesn't make it too onerous on the participant in terms of how much they have to repay back. But that way it gets back on schedule and can be paid off by the maturity date, which is required. All right. Now, what if I miss the cure period? Luckily, the IRS has the self-correction program, and they've opened that up to loans as well. It used to be that if you missed that 6-month cure period, you actually had to do a formal filing under the VCP program and pay that $3,000 fee just to fix a loan that was in default, right? Assuming you wanted to fix it. Now you can actually self-correct under the self-correction program and catch the loan up based on these methods right above on your own. But you do need to fix it. So how do we avoid this? Again, your investment providers,
Real
many are
quick,
going to have,
Steve,
yeah,
we did get a question.
yeah.
It says, what happens if an employee quits before their eligibility date was met, but there was employer contribution submitted to their 401k plan?
So a brand new employee quits prior to becoming eligible, but somehow there was a mistake by the employer and they sent in an employer contribution. That would be an ineligible employer contribution, and so you're able to go in to basically forfeit the money. We would have to help you with this at Nova, but you send an instruction to your investment provider saying, take the $50 of match that we put in and transfer it to the forfeiture account. So the money can't come back to the employer directly, but it goes into a holding account that you can then use to reduce your ongoing employer contributions. Any other
Thank you.
ones? No?
No,
Okay.
that was it.
All right. So again, avoiding these loan defaults determining what loans are delinquent and when. A lot of the investment providers have message centers, and they'll even send out emails in many cases indicating loans that are behind or haven't had payments made on them in a while. Now again, remember, if somebody terminates, obviously there are no more loan repayments that are supposed to go in, right? What you're looking for here is people that are actively employed who are not having loan repayments submitted to the investment provider. Those are the problem children right there. A terminated person, when they take their money, eventually and they request a distribution, the loan will be defaulted at that point. But you don't want people who are currently actively employed not paying on their loans. That's the problem we're trying to fix here or avoid here. So watch your message centers. You might even do a review of all of the people that have loan deductions coming out of your payroll system and then matching them up against people that have loans at your investment provider to see how well those two records match up and see if you've got some holes or maybe somebody, missed setting up a loan repayment for somebody that took a loan. Now, to make things a little bit simpler so there's not like multiple loans per person, most of our loan programs only allow for one loan at a time in your 401k plans. That way you don't have to monitor 3 or 4 loans per person. That can get very complicated, especially in payroll. So timely deposits of employee contributions. Again, this is a very important employer function, getting the money from the payroll and from your general account at your company over to your investment provider in a timely manner. So small plans have a different standard than large plans. The Department of Labor has given a safe harbor time frame that if you can get the contributions from the company account over to the investment account and into the participant accounts within 7 business days, that's considered timely. Okay. Now this only applies to the employee money, the deferrals and or loan repayments, and it doesn't apply to the employer contribution. If you're making a match, that could be delayed longer. Generally, if you're doing payroll by payroll submissions, though, you're sending in your match and your employee money all at the same time. But this standard is just for the employee money. Now, the Department of Labor also reserves the right to default a small plan to the large plan standard if you miss even one pay date on the 7-day business standard. So I've been good the whole year and one payroll goes in on day 8. If the DOL came in and audited, they might default you to this standard. So the large plans have a different standard. It's a little bit nebulous here, but the deposit is the earlier of as soon as administratively possible or the 15th day of the month following the pay date. Okay, you can forget the second bullet altogether. The Department of Labor standard is as soon as administratively possible. Now, what does that mean? That can mean different things to different people. Generally, the Department of Labor, if they audited, will come in and look at how you're, remitting other payments for employees. So if your withholding tax, for example, on those pay periods is being sent in within 2 days, they may make your standard 2 days, right? If you sent in some payrolls as soon as one day and all the others are 10 days late, or 3 or 4 days late, or they could make your standard one day. So it is a little bit gray area. We found in general, when we're dealing with audits, they'll give you 3 to 5 business days. You're pretty safe with 3 to 5 business days. Okay. But this is a huge issue on DOL audits. Also, your large plans are typically subject to a CPA audit annually, and your CPAs are looking into this timing factor as well. All right, so how do we fix this problem? And I'll tell you right now, this is a very common problem. NOVA fixes more late contribution problems than any other type of correction that we see. It's the highest volume thing we have going. But we have to calculate and submit lost earnings on the late contributions to these participants when they're late. The Department of Labor does not want the employer hanging on to employee money for too long. And if it's too long, you have to calculate interest and contribute that interest to the investment company on behalf of these people. It's also considered prohibited transactions subject to penalties. So there's some additional penalties submitted on a 5330 form that has to be submitted in addition to the correction. So determine, avoiding this problem, determine what applicable deadline you have for your plan, set up some procedures to ensure that basically your deposits are being made on the same date by the same time frame. And if you've only got one person doing this at your company, you might want to train a backup, right? Or have some backup plan. What happens if they go on vacation or they're sick? If you have multiple payroll runs for multiple companies, you need to be checking them all and make sure they're all on the same page. If you've got multiple people working on this, do they all understand this rule and what they need to be doing? Now, if you can, the best way to handle it is to set up a 360 connection between your payroll provider and your investment provider so that, participants, for example, make an election online at the investment provider, it feeds automatically to your payroll system. And whenever the payroll system is sending contributions, all that information is feeding automatically to your investment provider. And it just happens like clockwork every pay period. That's the best way to avoid this issue. But for sure, be consistent. If you're going to say, we're going to get this in within 3 business days, just make sure you're sticking to that standard on all pay periods. Another correction that we handle a lot here at NOVA is when employers deposit employer money into the wrong source. Okay, actually any kind of money, but by law, you're required to keep money segregated into different buckets. For example, employee deferrals, Roth has got to be in its own bucket. Your match is in a separate bucket. Profit sharing and so forth. If you're a safe harbor plan, the reason for this is many of these sources have different vesting schedules. They have different distribution rules. In the case of Roth, right, that's an after-tax contribution. So if you get money commingled in the wrong source, it's got to be fixed because people could get paid out wrong. There's a whole variety of mistakes that happen when money gets, commingled into the wrong source. Now, we also fix a lot of problems where plans are not sticking to the correct annual limit. Just so you know, the limit on 401k deferrals for 2025 for somebody that's under the age of 50 is $23,500, and then somebody that turns 50 at any time this year can put in an additional $7,500. Okay, so this limit applies to the sum. So you add your Roth and your pre-tax. It's not a different limit for each of these, after-tax versus pre-tax employee contribution sources, right? You add them together and then you figure out, stop that individual when they get to the appropriate limit. Okay. There is a brand new catch-up in case some of you were not aware. And it's in your plan documents now. So, or will be, because we're defaulting our plan to the Secure Act provisions that allow for this. But participants that are age 60 to 63 have a different catch-up amount. They can put in more. They can put in an additional $11,250 this year. So are your payroll systems set up to catch this? Right? I would check that if you're not sure. But this is available now. First time this year. Another problem that happens, this is through payroll that this happens. If you're making a matching contribution, there's a limit that's created due to the fact that the IRS imposes an annual compensation cap each year. So the cap for 25 is $350,000, and this can float. Generally, it's been going up each year, but the way that works is if you have a safe harbor plan, for example, and in those safe harbor plans, it's 100% match on the first 3% and an additional 50% on the next 2%. So that formula caps out at 4%, if you do the math, right? Because we cannot count more than $350,000 of compensation in a 401k plan, you multiply 350,000 times 4%, and the most under that formula that any one individual can get in match is $14,000. All right, so make sure that you've set up your limits properly in your payroll system to cut somebody off the minute they get to 14,000, right? Any amounts over 14,000 need to be forfeited along with earnings, which Nova can catch. But the problem is we only look at it once a year. So let's say that you have somebody that you over contributed for and you put in like 20,000 by accident, and that person leaves and takes their money before we can catch the error, which is after the plan year ends, right? The company's going to be out the money more than likely, right? They're not going to get that money. You're not going to get that money back from that individual. So make sure your limits in payroll are set up. Again, that's just talking about what I just said. So I think we're almost at time. I think we're just about done here. Another part of the duties that you have as an administrator is to get notices and the summary plan description out on time. Now, some of the more common notices are if you're a safe harbor plan, you've got an annual notice that has to go out. If you have automatic enrollment in your plan, that's an annual notice that has to go out every year, right? There's the fee disclosures. There's summary plan descriptions. We do send out a lot of correspondence as Nova when with some of these notices, especially the safe harbor notices and automatic enrollment, providing you with a notice for that year, because being a safe harbor plan is a year-to-year election, and so you have to give an annual notice every year. So I think since we're right at the time, we're just about done. Yeah, hold on. So one thing to notice about forfeitures, I might as well finish up here. What do I do with the forfeiture? So, right, all that non-vested money that flows into my forfeiture account from people that leave. So you can use that per our plan document. You can use that to pay plan expenses if you want, or it's pretty flexible. You can pay plan expenses. You can reduce your ongoing employer contribution obligations. So if I'm making a payroll by payroll match and I have some money stored up in my forfeiture account, get with your investment provider to find out how you can use up some of that money. So instead of them drafting your bank account to take the employer money, they can take the money out of the forfeiture account and make up that money. The one thing you never want to have happen is you never want to request the money back as the employer. That's a prohibited transaction. So the money, either you're paying plan expenses or employer contributions. Now, I can tell you right now, the IRS has become a stickler for using up those forfeitures. You do not want to let those forfeitures just build up year after year in your forfeiture account. The audits that I'm going through now, they're looking at what does your plan documents say about how to use forfeitures, and are you using them regularly? right? If you're not, they could easily penalize the plans that are not doing this. So, do we have any other questions at this point, Ava?
We do have one, but we will email her with that
Okay.
answer. But thank you so much, Steve. Just a reminder to everyone, if you do need the handout for today's presentation, go ahead and click that handout PDF and you can download it. If you're unable to download it, just email us at webinars@nova401k.com and we'll be sure to get that to you. To view any webinars you may have missed in the past, go ahead and visit our YouTube channel. This webinar will be available there by the end of the day. Thank you so much again, Steve, for today's presentation, and thanks again to everyone for joining. We hope you have a great day.